this wonderful chapter, Capital Market Primary. Preference share we have seen. Now we will see debentures and bonds. Good news. There is a big chapter in SFM, bonds and debenture. So next few paragraphs are directly taken from there only. So I will go through it little fast compared to the earlier discussion because you know it. If required, I'll stop and explain. So what is a bond? A bond is a long-term debt security. A bond cannot be a short-term, and long-term means usually 5 years and more. Okay. It represents a debt in the bond, in that the bond buyer actually lent the face amount to the bond issuer. So bond is nothing but a loan given by the holder of the bond to the issuing company. Okay. And the company issues a certificate called bond certificate. Nowadays it is in demat form, which shows the creditor and lender relationship between the company and the bondholder. It is a security because unlike a car loan or a home improvement loan, the debt can be bought and sold in the open market. Why it is called an instrument or a security? The moment they say instrument or a security, it means these are tradable in nature. It means they are tradable in nature. They can be bought and sold in the market. So nowadays there is a market for bonds and debenture also, where they can be traded, and hence they are called either security or instrument. In fact, a bond is a loan intended to be bought and sold. Bank loan cannot be traded. Loan from financial institutions cannot be traded. But when the same loan divided into small pieces and each piece is called a bond and debenture, they can be traded in the market, and that makes the instrument more attractive. It is a long term by definition. The meaning of the but bond, you and your friend have great bond between you. Is it for short term or for long term? Long term, unlimited, or at least for long term. So this word bond itself signifies a long term relationship. That is why this word bond has been designed. It shows a long term relationship or a long term commitment in order to be called as a bond. The term bond is long term commitment. Normally the long term means 5 years or more. If there is a debt security, underline, very interesting line, but the maturity period is less than 5 years. Maturity period is less than 5 years. Then it is called bill or notes, or it can be called as other terms. So sometime in some books you will find this word note is written. Note is also a form of debt instrument, but maturity period is less than 5 years. Since bonds are intended to be bought and sold, now this question you will keep in mind in the exam. A debt security whose maturity is less than 5 years is called dash. Option A, note. Option B, bond. So you will tick mark note. Bonds are intended to be bought and sold. All the certificate of a bond issue contain a master loan agreement. So there is a master loan agreement, then under that bonds and debentures are issued. The agreement between the issuer and the investor is called bond indenture or deed of trust. Again underline. For a fill in the blanks question or a MCQ question, agreement between issuer and investor of a bond is called dash. So you will write bond indenture or deed of trust, contains all the information that you would normally expect to see in any loan agreement. Okay. Just like when you take a loan from a bank, you have a long list of terms and conditions. Similarly, when you issue bond or debenture, you have to enter into a form of loan agreement with the debenture holders, and that is called bond indenture or deed of trust. Now you are going to become CA and then finance manager, then CFO. Why would you like to issue bond? Why would you issue debenture? What motivates you to issue bonds and debenture? So first I'll make an overall summary of why we need bonds and debenture, and I'm going to explain it simultaneously also. Government is a major issuer of bond. We call government bond. Why do government issue bonds? Government has to incur expenses for management and running of such huge country. So from where will they raise funds? First they try to extract as much tax as possible from you, okay, in the name of GST, direct tax, DDT, surcharge, cess, or whatever name they will extract from you, but that may not be sufficient. Whatever is deficiency, then they borrow money, okay, by issuing debentures and bonds. So government issue bonds to meet their expenses, because public expenditure in India is very high. They have to give subsidy, police force, army, defense, okay, railway, port, all these require funds, and only government can incur those expenses. Corporates issue debenture and bonds for second point in your book, because it is one of the cheapest sources of finance. As you know, for companies, cost is very important. To survive in a competitive environment, cost must be reduced. Both operational cost like salary, wages, power, rent, and financial cost like interest and dividend. So you can issue bonds at a lower rate of interest compared to other instruments. The reason is you give security. Second reason why the bond or debenture has a lower cost of capital is you tick mark this point also simultaneously. These 2 points which I am highlighting right now are actually same point. Interest on bond or debenture is a tax deductible expenditure. Say for example you have raised 100 rupees is your bond face value. You are paying an interest of 10 rupees, but tax rate in India is, let's say, 30%. So your tax saving, because you will debit interest in the P&L account, you will save 3 rupees in taxation. So what is your net outflow? 7 rupees only. So your effective cost is not 10 or 10%, but your effective cost is only 7%. Whereas if you would have issued preference share at 10% dividend rate, you have to not only pay 10, you have to also pay dividend distribution tax. If you issue equity share, you have to pay higher dividend and tax on dividend. India is a cost conscious country. Every businessman is cost conscious for that matter, and therefore bonds and debentures are favorite sources of finance for Indian corporates. They will borrow as much as they can, whenever they can, from wherever they can. Is it right? And many of them don't bother about repayment also. That is another reason for borrowing, but you will not write that. Next is financial leverage. Financial leverage means return on capital employed is greater than rate of interest. Using borrowed money, I'll do business and I will earn 20% return. I borrowed 100 rupees, I started a business, I earned 20 rupees income. But I have to pay an interest of only 10%. So this surplus 10% accrues to whom? Accrues to the shareholder. It goes into shareholder's pocket. This is called, in technical world, a concept of financial leverage. Using borrowed money to magnify the return of shareholder is called financial leverage, and that is possible only when this condition is satisfied. Otherwise it will work in a negative direction, reverse direction. Point number 4 I have explained, interest is tax deductible because income tax says it is a business expenditure. One more strong reason for issuing bonds and debenture is point number 5 in your book. No voting right. You are raising money also and you are not compromising with your voting rights. So voting rights remains with the shareholders. They can't vote. They can't influence your decision. They can't interfere in the decision making. Okay. So these are the reasons for issuing of bonds and debenture. Long back in SFM there was a question when this chapter was in SFM, theory chapter. What are the information contained in a loan agreement? If you do articleship, then maybe you have seen some loan agreements, yes or no? If you go to a client, he has borrowed money from a bank, you say, I want to check your loan agreement, and then you'll get a chance to see the entire loan agreement. Question can be, what are the terms and conditions included in the loan agreement generally? Technically, terms and conditions are called covenants, because the question in the exam were, write 5 covenants included in loan agreement. Write 5 covenants included in loan agreement. Then student is wondering, what is covenant? Terms, conditions. So I have made a long list of items which you will usually find in a loan agreement. This list cannot be exhaustive, okay? Because there can be many other issues. According to the situation, they can add some more points in the loan agreement. Of course, the loan agreement will say, what is the amount of loan? How much the bank is lending you and how much you are borrowing. The loan amount is called face value, par value or principal amount. This is the amount that bond issuer has agreed to repay on the maturity of the bond. Okay. Second, it will always contain rate of interest, unless it is a zero coupon bond or a deep discount bond. Rate of interest means coupon rate. Technically, in bond debenture, the interest rate is called coupon rate or nominal rate, which is determined largely by market conditions at the time of bond's primary offering. At what rate of interest will the bond be issued? Now depends on when are you issuing the bonds. If you are issuing a bond in a situation where in the market other bonds with similar credit rating, similar risk, similar maturity are giving a return of 8% to the investor, you also will have to pay 8% to the investor, otherwise he will buy it from the other bond or other debenture from the market. So therefore it depends on market conditions. If you want to give more than or less than market condition, then you have to issue it at either premium or at a discount, so that effective return to the investor come to 8%. Is it right? If a good company is issuing one, so there, yes, because then its credit rating is better. Now then there is no comparable, because if you are saying Reliance with some Muthoot Finance, so of course Reliance and Muthoot Finance have different level of risk. So therefore you can bargain a lower rate of interest. I am saying when two instruments are exactly same, then the coupon rate will be decided such that it matches with the other instrument. Okay, maybe sometimes some percentage lower or higher to attract the investor, higher. Once determined, it is contractually set for the life of the bond. So therefore coupon rate should be determined carefully, because once you say 14% coupon and it is a 20-year bond, you have to pay 14% for 20 years. Of course, you can have a call option. In that case, you can redeem the bond before maturity. But that again has to be specified at the beginning. The amount of interest payment can be easily calculated by multiplying the rate of interest by the face value of the bond. For example, face value is 1000, coupon rate 8%. How much annual coupon this company would pay? 80 rupees. No, this was a waste of the time of our talented student. Yes or no? 1000 into 8% is 80. Question right now is, what are the covenants in the loan agreement? First point was amount, second was rate. Third is schedule or the form of interest payment. If you look at the bond or debenture or loan agreement, they will mention how the payments will be made. Normally in India or in most other countries also, interest is paid semi-annually. Normally, interest is paid semi-annually, means once in 6-month interval, but sometimes it is annual also. For the student, if he is answering a numerical question on bond and debenture valuation, unless otherwise specified, he will assume annual coupon payment. Okay, if suppose a numerical question is given, I am going to solve 2-3 numerical questions today. Assume annual coupon payment, and again when it is paid, usually on either the 1st or the 15th of the month. These are the conventions they follow, but you don't have to remember to this extent. If you can, well and good, otherwise you have an open book exam. Interest is paid normally semi-annually on the 1st day of the month or 15th day of the month. So if it is a semi-annual bond, like in previous example, 80 rupees will not be paid to you, rather you will be paid 40 rupees in 2 installment in a year. Next thing they will mention in the bond debenture deed is the maturity. Okay, maturity means after how many years the principal amount of the bond will be redeemed. So normally it is 5 years and above. Normally bonds and debentures are issued for 5 years and above, but again it depends. Debt that matures in less than 1 year. Suppose there is a debt instrument but it matures in less than 12 months, then we don't call it as a bond, rather we call it as a commercial paper or banker's acceptance. So you will see commercial paper in money market instrument, because usually the maturity period of commercial paper is less than 12 months. A short-term bond on the other hand may have an initial maturity of 5 years. So just underline, short-term bond may have an initial maturity of 5 years. And first line, maturity or length of time varies greatly but is usually greater than 5 years. Then underline, long-term bond typically matures in 20 to 40 years. These are for multiple choice question, fill in the blanks question, true and false question. Okay, the maturity of the bond is predetermined as is stated in the trust indenture. That means at the time of issue only, the company will have to inform the investor in that trust indenture that this bond has 5-year maturity, this bond has 20-year maturity, or this bond has 50-year maturity. Okay. Some bonds have call feature also. Some bonds have call feature also, but again it has to be specified in the beginning. What do you mean by call feature? Can be redeemed before maturity by the issuing company. If the bond has a call feature, then it allows the issuing company to call in the bonds and repay them at a predetermined price before maturity. Will the investor accept such bond? Will you invest in a normal straight bond or a callable bond? So such bonds are not very attractive for the investor, because company would call back the bond when the market rate of interest is high or low? Low. First you issued a bond at 14% interest rate for 25 years. But after 5 years you found that the market rate is now 9% only for a similar bond So you would like to redeem the previous one and reissue the new one. So who will be at a disadvantage? The investor. Because the investor was enjoying 9%, 14% interest, and he's going to enjoy that for many more years to come, but all of a sudden you redeemed, and now he will be able to reinvest it only at 9%. So therefore, what this company do, they pay some call premium. They pay some, that means if I redeem before maturity, I will redeem it at a premium to compensate the bond holder for a loss. Bond issuer use this facility to protect themselves from paying more interest when they have to pay for the money they are borrowing. Companies call in the bond when general interest rates are lower than the coupon rate on the bond, thereby retiring expensive debt and refinancing it at a lower rate. So the question would be, why would a company issue a callable bond? So you will say, when the company is issuing the bond, it thinks that in future the coupon rate or interest rate in the market may fall. To take the advantage of that fall in the interest rate in future, they will add the call feature, so that if the rate of interest actually goes down, they can redeem the old bond, issue the new bond and save the interest cost. But if the rate of interest goes up, they will continue with the old bond. Okay, so that is why they add call feature. One example also the institute has given. There is a company IDBI. It had issued one callable bond, face value 1000, maturity 6 year. Coupon rate was 14% per annum at the time of issue. But later on, the coupon rate or current interest rate in the market was 9 to 10%. So what it will do, if the issuer wants to take advantage of the call feature in the bond's indenture, it will call back the earlier issued bond and reissue them at 9% per annum. So how much will be the saving? Around 5%. Of course, there is a lot of other costs associated with calling the bond, like you have to pay call premium, you have to incur the flotation cost of the new bond. Is it right? And sometimes you may have to pay overlapping interest also for few days to few months. Overlapping interest means first you will have to issue the new bond, raise money, then redeem the old bond. So for some days, old bond is also outstanding, new bond is also outstanding. So you have to pay overlapping interest. Is it right? So these are cost. But of course, what you will do, you will do cost benefit analysis. If benefit is more than cost, you will refund the old bond. The sale proceed of the new issue will be used to pay the old debt. In this way, IDBI enjoys a lower cost for its borrowed money. So that was an example. Such bonds offer call protection. Underline what is call protection. That is, they are guaranteed not to be called for 5 to 10 years. So question in the exam will be, dash means a callable bond will not be called for 5 to 10 years. Dash means, so you will fill in the blanks, call protection. Call protection means a callable bond will not be called for a specified period. Call features can affect bond values by serving as a ceiling for prices. Call feature affect the value of the bond. Call features affect the value of the bond. Investors are generally unwilling to pay more for a bond than its call price, because they know that in case if this bond is called back suddenly, this is the amount I am going to get. So price of a callable bond would not increase its call price. What is call price? Underline call price means amount payable on redemption of callable bond. Amount payable on redemption of a callable bond, because they are aware that the bond could be called at a lower call price. So it puts an upper limit. If the bond issuer exercises the option to call back the bondholder is usually paid a premium over par for the inconvenience. So what is the only motivation for investing in a callable bond? You'll get the premium. Okay, that premium will be specified in the bond indenture. That is the terms and condition. That premium can be a fixed amount. That premium can be equal to 1 year coupon payment also. Okay. As a student, that will be given to you in the problem. But normally the premium is equivalent to 1 year coupon, normally. But otherwise, it will be given. Now, next paragraph is refunding. Refunding of a callable bond. If when bonds mature, the issuer does not have the cash on hand to repay the bondholder, it can issue new bond and use the proceed either to redeem the older bond or to exercise a call option. This process is called refunding. Now I am going to take a question which is not in the study module of financial services and capital market, but this is a small case study I am going to solve, whether the old bond should be refunded, whether the old bond should be refunded or not. Now how to take a decision whether an old bond should be refunded or not? It is a cost benefit analysis. There are some costs, there are some benefits. Compare present value of benefits with the present value of cost. All figures should be converted into present value. If present value of benefit is more than the present value of cost, answer, call back the old bond, issue the new bond. Otherwise, continue with the old bonds. Okay. So what I'll do, I will divide my discussion into two paragraphs. It is printed in your book also. One is what will be the cash flow in year 0. And second, what will be the cash flow over the remaining maturity. So first you understand cash flow in year 0. Visualize what are the cash flow possible. First is you will pay call premium. Two types of questions can be asked: with taxation, without taxation. Normally with taxation they will ask you, otherwise there is no thrill in the problem. Yes or no? There is no action, drama, melodrama in the problem if it is without taxation. And what is the life of a CA without taxation? So with taxation, so what you will do, first you will calculate the call premium amount. But call premium you are paying means it is an expenditure. So less tax shield. Call premium less tax shield. So you will get after tax cost of call premium. This is an inflow or outflow? This is outflow. Understandable. For example, suppose you have to pay 15 lakh rupees premium and 30% is the tax rate. So this is the tax saving. 15 lakh you will pay, but 30% of 15 lakh you will save. So effectively my net outflow will be 15 lakh minus 30%, which if I want to write, it will be 10 lakh 50,000. Just check. Okay. Then I will have to incur the flotation cost of new bond, which is printed in your notes, means issue expenses. Again you have to incur that merchant bankers fees, underwriting fees, legal fees, advertisement, whatever. So this I will write here as outflow. What about the tax shield on this? Tax shield will be given to you over the life of the bond. So that will come in my second table. Okay. Tax shield will not be earned immediately on flotation cost because we have to follow income tax rules. Third is overlapping interest. Of old bond, again net of tax. Overlapping interest of old bond, net of tax. What is overlapping interest? Now suppose I have to decide that I want to refund the old bond and issue the new bond. First I will issue the new bond and then I will refund the old bond. True or false? First I have to raise money, then only I can repay others. If you are, suppose, a person who has to pay to your friend, Ram has to pay to Mohan. So first Ram will borrow from Sohan, then only it will pay Mohan. Is it right? Because student in our batches in SFM, sometimes they also answer like this. First I will redeem old bond, then I will issue new bond. Arey bhaiya, from where will you redeem the old bond? You need money first, na? So I will issue the new bond on 1/1/2020, but I will redeem the old bond on say 1st February 2020. So during this period I am paying interest on new bond also because the meter has started, and I am also paying interest on old bond also. That means for this 1 month period I am paying extra interest on the old bond. Is it right? So this is called overlapping interest of old bond. This is my cost. It may be 1 month, 15 days. Because see, practically it is not possible that exactly on the same day you receive the funds also and you pay it also. Although in the classroom problems it happens sometimes, but practically it may have some time gap. So during that 15 days, 1 month, 2 months, 3 months, you have to pay interest on both the bonds. So this will be my cost now. And if taxation is also given, then net of tax, because interest is a tax deductible expenditure. Since the time period is usually only few days to few months, time value of money is ignored here in the calculation of present value. Otherwise, more appropriately, you can calculate the present value also. Is it right? You can also calculate present value because it will be paid after 1 month or 2 months. But because the impact of present value will be very minimum for 1 month or 2 months, we can ignore it. Okay, point number D. Now point D, E, F is very important for you to understand. Tax saving from unamortized discount on old bond. Tax saving from unamortized discount from old bonds. Tax saving from unamortized discount from old bonds. What is this item? Let's say the old bond was issued at a discount. This line will be applicable only if the old bond was issued at a discount. Otherwise, ignore this. And discount is also amortized over the life of the bond. So I'll put some number for understanding. Suppose in the old bond you had given a discount of 2 lakh at the time of issue. It's a 20-year bond. 20-year bond. 2 years are over. So first question is, how much is the unamortized discount? 2 lakh divided by 20 first. Means you are amortizing 10,000 rupees every year. 2 years are over, means 20,000 you have amortized. So 18 into 18 is unamortized portion. 20 minus 2. So tell me the amount. 1,80,000. This you will have to calculate. This will not be given to you in the exam. That much a student of CA course can do, or student like you can do. So what I'll do, once the old bond is redeemed, I'm going to write off the unamortized discount. Once the bond itself has been redeemed, now I can't keep on amortizing that discount, so write off. So when you write off, you'll get the tax shield immediately. So you will write tax saving 1,80,000 into whatever tax rate they will give you, say 30%, so 54,000. In our example, it is inflow. One more thing I forgot to write, overlapping interest, you will show it as outflow. Flotation cost, outflow. Call premium, outflow. But tax saving from unamortized discount of old bond is an inflow. Okay. On the same line, exactly same discussion. Suppose you had issued flotation, you had incurred flotation cost on old bond and you are amortizing it. 2 lakh rupees flotation cost incurred, 20-year life, 2 years are over. So 1,80,000 is the balance in unamortized flotation cost. Since the bond is redeemed, the related flotation cost will be written off, and therefore you'll get the tax shield immediately. So that I will call tax saving from unamortized flotation cost of old bonds. So inflow. How will you calculate? First find out what is the unamortized portion, and that you multiply by tax rate. This is applicable to both lines. You can write in bracket if you want. I am expecting a question on this portion of your exam, whether old bond can be redeemed or not. Can be a case study. Okay, for 20 marks. Next line, discount on new bond. Inflow or outflow? Outflow. Student can ask a question, what about the amount received by issue of a new bond? But at the same time also I am paying amount to the old bond holder. So if I have raised 10 crore, if I have paid 10 crore, that will not affect my answer. However, if you pay more to the old bond holders, that will affect your answer. Or if you have received less on the new bond issue, that will affect your answer. So premium paid to old bond holders, discount on the new bond will affect. Otherwise, what you should do, you can write two lines instead of A and F. What you can do, you can write issue proceeds of new bond, payment made to old bond. Will the answer be same or different? The answer will be same. But do not forget to take into account the call premium on the old bond. Is it right? So these are different ways of presentation. My cash flow should be the same. Take total of this, not now, when we'll solve the problem. This will give me net inflow or outflow in year 0. No need for discounting of this part. Why? Year 0 only. But then we have to also learn that there will be some cost and benefit in future also because of my decision. So my next task is cash flow over remaining maturity. Here also we'll quickly discuss what are the cost and benefit. One is interest. The main reason for taking this decision to refund the old bond and issue the new bond is to save the interest. Interest saved, again in a problem where taxation is given net of tax. How will you do this calculation? Calculate interest on old bond less interest on new bond. So the difference between these two, 1 and 2, will give you interest saved, right? And then there is a disadvantage of saving interest. You lose the tax shield, less loss of tax shield. Suppose to understand this figure comes to 50 lakh and loss of tax shield is 15 lakhs. So what you effectively saved is 35 lakh. Will this be inflow or outflow? Inflow. And for how many years? Over remaining maturity. If 20 years was the original period of old bond and 2 years are over, so now I will take 18 years, 1-18. Every year you are going to save this amount. Then second thing, tax saving from amortization of flotation cost of new bond. Do you remember? We have not considered the tax shield on new bond in the first working note. So now I will calculate. How will you calculate? See how much is the flotation cost of new bond. Divide by remaining maturity into tax rate. You can write those you want. Suppose the new bond was issued at 4 lakh rupees flotation cost and remaining maturity is 18 years. So every year 4 lakh divided by 18, you will amortize, you will write off. And suppose the tax rate is 30%, into 30% will be your tax shield every year. Inflow or outflow? This will be my inflow. Okay, this will be my inflow. But if you remember in the first working note, you have claimed the tax saving from amortization of flotation cost of old bond. If you have claimed it in year 0, you will not be able to claim it in the future year. So your decision to refund the old bond will only accelerate the process of amortization of flotation cost of old bond. That means the benefit that you are going to get in future, you will get now. So what you actually benefit is the time value part, because this benefit you are going to receive over 18 years, you claimed it now. So what is the net gain is the time value of that money. So I am going to write here now, point number C, loss of tax saving from amortization of flotation cost of which bond? Old bond. It's written in your book also. How will you calculate? First you calculate, or it will be given, flotation cost of old bond divided by number of years. How much we were amortizing? Number of years of old bond. Number of years of old bond. Suppose the flotation cost of old bond is 2 lakh and it was issued for 20 years. It means I was writing off 10,000 rupees per annum and I was getting a tax shield of 30% on 10,000 every year. But now I will not get it. So this I will present as an outflow. It's a loss to us. Here it is outflow, but I am going to previous slide where it is written as inflow. So the difference between the two is your net benefit only due to your decision to refund the old bond. You have only accelerated that process. So time value of money is the advantage here. Okay. Have you noted up to this? I hope you have understood. Exactly like flotation cost without detailed discussion, discount. You will get the tax shield on discount of new bond. Tax saving from same amortization of discount of new bond, correct? Inflow. But because you have already written off the discount on old bond in the first table, now you will not get the discount on the old bond. So therefore loss of tax saving from amortization of discount of old bond. Calculation is same like flotation cost. The way we do this calculation, we'll do this two calculation also. Is it right? In some exam they may not give you discount. Ignore point D and E. Whatever is not given, ignore. Some question does not give you overlapping interest. Ignore it. Okay. Now the next question is, you will take a total. But these are the cash flows over a number of years. After doing this total, calculation of present value of net cash flow, whatever is net, positive or negative, that you will get to know only after calculation. Is it right? And then compare this figure with this total. And if the net total is positive, net total is positive, net effect is positive, then refund the old bond. Now the last thing before we take a question, which discount rate you will use here? Discount rate. First discount rate, if the question specifies a discount rate, use it. Otherwise take after tax cost of interest rate of new bond. After tax interest rate of new bond, if taxation is there in the problem. So just write a note below, I'll dictate. The discount rate to be used, should be after tax interest rate of new bond. After tax interest rate of new bond. However, if any specific discount rate is given in the problem, use the same. If any specific discount rate is given in the problem, use the same. Like this example on the screen, when we will read, there is a specific discount rate given in the problem. So I'm going to use it in solving the problem. So quickly we will solve one small case study which will form part of a bigger case study in the exam. Okay. ASF Limited has a bond outstanding of rupees 3 crore. The bond has 12 years remaining until maturity. It has 12.5% coupon and is callable at rupees 1050 per bond. It has a flotation cost of rupees 4,20,000 which are amortized at the rate of rupees 30,000 annually. I will stop here to understand. 4,20,000 divided by 30,000 means what was the original maturity period of the old bond? 14 years, but they have written here 2 years, 12 years. 2 years are over. So my question is, if 2 years are over, what is the unamortized flotation cost? There are two ways you can do the calculation. Directly 30,000 into 12 you can do, or 4,20,000 minus 2 times 30,000. So that will also give you 3,60,000. So this I will require in year 0 because this will be written off, and this I will require over 1 to 12 years. The flotation cost of the new issue will be 9 lakh. So this 9 lakh will be amortized over 12 years. That is 75,000 per annum over 12 years, and the current interest rate will be 10%. Earlier you were paying 12.5. So you are saving 2.5%, and you're going to save it for 12 years. So that's a big saving. Interest 2.5% on 3 crore for 12 years. If a sentence like this appears, which means this is the discount rate for computation of present value of future cash flow. Should the firm refund the outstanding debt? And last line will make your life miserable because tax rate is given 50%. In this question, face value of each bond is not given, but there is a hint here. Callable at rupees 1050 per bond. So what do you think should be the face value of the bond? Can we assume 1000? Because normally bonds are issued in round figures: 100,000, 5,000, 10,000, 1 lakh, 5 lakh. So 1000 we can assume. Then why they are paying 50 rupees? Call premium. So if you assume it is 1000 and 3 crore is the face value, can you tell me how many bonds were issued originally? 3 crore divided by 1000, 30,000 bonds were issued. 3 crore divided by 1000, and the premium you are going to pay is 3000 bonds into 50 rupees is 15 lakhs. Haji? Is it right? 15 lakh? So call premium is a hidden figure. After so much of discussion, we came to the conclusion 50 rupees per bond you are going to pay as premium. On that you are going to save 50% tax also. So my effective outflow on call premium will not be 15 lakh. 15 lakh minus 50%. 7,50,000. So what you have to do, you have to arrange this data properly and find out the net saving. And if it is positive, refund the old bond. Okay. So first you write down in your notebook. You have to write in notebook. There is no space. Write little fast. Face value of the bond is assumed to be rupees 1000. Face value of the bond is assumed to be rupees 1000, which is a very reasonable assumption. Hence number of bonds equal to, therefore number of bonds equal to 3 crore divided by 1000 is equal to 30,000. This is understandable. Then write unamortized flotation cost of old bond. Unamortized flotation cost of old bond 30,000 per annum into 12 years. 30,000 per annum into 12 years. Three lakh 60,000. Now what I am going to do, I am going to first make a complete list of all the cash flows and compute the net present value. Is it right? So write down, any way you present, I don't have any objection. Final answer must be the same. Okay. In different books, this question has been presented in different formats, but all of them ultimately reach the same net present value, net saving. So evaluation of the proposal to refund the old bond. What is my case study? Evaluation of the proposal to refund the old bond, and the decision will be based on net present value of the decision. If it is positive, yes. If it is negative, no. Draw this table. Year particular cash flow, discounting factor at 6%, and discounted cash flow. Okay. Say yes. Yes. Why discounting factor at 6%? Because they have given. Had they not given, then I would have taken interest rate on new bond less tax shield. Okay. It would have come 5%. 4 point. No, 5%. No, 10% is interest rate, 50% is tax rate. It would have come 5%. Anyway, but we'll take 6 because it's given. Write down what are the cash flows in year 0. As we have discussed, we will pay call premium on old bonds, which is a tax deductible expenditure in the same year. So net of tax. 30,000 bonds into 50 rupees, 15 lakh minus 50% tax saving. So my net outflow is 7,50,000. Yes or no? Yes. Present value will also be 7,50,000. Anything else in year 0 you want to write? Give me 2 more figures. 2 more. Flotation cost of new bond. Outflow 9 lakh. Trade tax shield later. One more item I will write. That unamortized flotation cost of old bond will now be fully amortized. So you will get tax saving from unamortized flotation cost of old bonds. Tax saving from unamortized flotation cost of old bonds. Now you see the calculation. 30,000 per annum into 12 years. 3,60,000 is unamortized value. When you will write off it, you will get tax shield 50%. So that comes to 1,80,000. These are the 3 cash flows in year 0. Then in next 12 years, there is one major advantage. We'll save interest, but will not be able to save some amount of taxation. When you save interest, you lose tax shield on interest. So see the calculation. Interest saved net of tax. This is my face value of the bond, 3 crore, into, in bracket, 12.5% minus 10%. 12.5% is interest on old bond, 10% is interest on new bond, so net saving is 2.5%. So you are going to save interest, but you are going to lose tax shield on interest. So net of tax, if you have to do the calculation, you have to write 1 minus 0.50. Is it right? So you are going to save 3,75,000. 7,50,000 you will save, but 50% of 7,50,000 you would lose. So my net saving will be only 3,75,000. Check the discounting factor. Is it 8.3838? Say yes or no. So what is my discounted cash flow? DCF, discounted cash flow. 3143925 rounded off. Two things more you have to give me. You have flotation cost of new bond, tax shield on that. This you have already claimed here, so you will not be able to claim in the future period. So year 1-12, write down tax saving from amortization of flotation cost of new bond. Tax saving from amortization of flotation cost of new bond. So you have 9 lakh, divide by 12 years, 75,000 per annum into 50% tax rate. So that will give you 37,500. Multiply by factor 8.3838. Take calculator, multiply. How much it comes to? 3,14,393. Yes or no? Dear student, one more thing you have to write. If you have already claimed the tax shield on unamortized flotation cost of old bond in year 0, now you will not be able to claim. So write down loss of tax saving from amortization of flotation cost of old bond. $30,000 you are claiming every year into 50% is 15,000. Is right? This one 9 lakh. Okay, I'll add 1 0 here. You are right. This 15,000 is clear. This is a loss, so outflow. Factor 8.3838. 6% 12 year present value factor is 8.3838. Annuity factor. Multiply, just check, is it 125,757? Now take the total of all the numbers. You can prepare this answer in 2 working notes. Year 0 working note, year 1 to 12 working note, and then also you can find out the net present value. Okay, presentation can be different, but the final answer will be 18,62,561. Positive or negative? Properly you have done or copied? Copied, nalak. Check first, it may be wrong. This format gives you the entire presentation at one place. Otherwise you can bifurcate into 3 working notes. Only year 0, 1 to 12 and then net benefit. If it is positive, then you have to write a note. Recommendation. What is the recommendation you will give to this company? Company should refund the old bond. Company should refund the old bond because the NPV of the decision is positive. Because the NPV of the decision is positive. Okay. This answer is over. This way you will solve the problem. Please practice from SFM book also, because there we have taken many questions. Okay, or any other book of SFM if you have, you practice a similar problem from there. Now we will continue tomorrow.